Most people believe markets reward effort, that if you study harder, execute cleaner, and control emotion better, the outcome eventually improves. It is a comforting belief. It is also incomplete. Some markets do not punish bad execution. They punish participation itself. This is not about being early or late. It is not about risk management errors or emotional lapses. It is about environments where the structure is tilted so deeply that skill only slows the damage. The uncomfortable truth is that legendary professionals did not succeed by trading everything well. They succeeded by refusing to trade certain things at all. One of the most revealing habits of George Soros was not what he entered, it was what he permanently excluded. Not paused, not reduced, not revisited later. Excluded. Because at a certain level, you stop asking how to win. You start asking where winning is even possible. Retail traders rarely think this way. They ask which setup works best. Professionals ask which arena quietly extracts value, no matter how well you play. This distinction changes everything. Most losses do not come from bad ideas. They come from choosing environments where the odds never reset in your favor. That is the first disruption. Loss is not always a mistake. Sometimes it is a fee for entering the wrong structure. There are markets where volatility looks like opportunity, but volatility is not opportunity by default. It is only opportunity when you can act faster, cheaper, or smarter than the average participant. If you cannot do at least one of those consistently, volatility becomes noise, and noise slowly erodes capital. Here is the part few people want to hear. Better execution cannot fix a structurally hostile market. It can only delay the outcome. That realization does not arrive early in a career. It arrives after years of refinement, after systems improve, after discipline hardens, after losses persist anyway. At that point, the professional stops asking what they did wrong. They ask whether the game itself is misaligned. Soros understood this early, not intellectually, experientially. He noticed that some instruments demanded perfect timing just to break even. Others punished hesitation more than incorrect direction, and a few offered no asymmetric upside even when the thesis was correct. Those markets were not difficult, they were indifferent. Indifference is more dangerous than risk. Risk can be priced. Indifference cannot. This is where identity disruption begins. Retail culture teaches adaptability as a virtue. Be flexible, trade everything, never limit yourself. Professional culture teaches selectivity. Constraints are not weakness, they are defense. Every permanent exclusion is a form of capital protection, not just financial capital, cognitive capital, emotional capital. Time. Time is the real cost people ignore. A structurally bad market does not just take money, it takes attention. It keeps you busy without moving you forward. Busy feels productive. It is not the same thing. That distinction separates amateurs from professionals faster than strategy ever will. Here is a pattern few people talk about. The more instruments someone trades, the less they understand each one. Not because they are incapable, because structural nuances demand focus. Every market has hidden mechanics: liquidity behavior, participant incentives, reaction asymmetries. You cannot master those at scale. So professionals do something that looks boring. They shrink their universe, and then they remove entire categories permanently. Not because they are afraid, because they are precise. This is where most people misread Soros. They focus on his boldness. They miss his restraint. Restraint is invisible. You cannot screenshot a trade you never placed. But restraint compounds quietly. The first market professionals abandon is not the most obvious one. It's the one that feels sophisticated. The one that promises leverage without responsibility. The one that offers complexity as a substitute for edge. Complexity attracts smart people. That's why it's dangerous. When a market requires constant adjustment just to maintain neutrality, it is not neutral. It is adversarial. Adversarial structures do not reward intelligence. They reward positioning. And if you are not positioned where information flows first, you are reacting, not trading. Reaction feels like participation. It's actually consumption. Consumption dressed as strategy drains accounts slowly, often invisibly. This is why permanent avoidance matters. Temporary avoidance implies hope. Permanent avoidance implies clarity. Clarity is expensive. It usually costs several cycles of loss. Once clarity arrives, the professional changes posture. They stop scanning endlessly. They stop chasing novelty. They start asking a different question. Where is my disadvantage smallest? Not where profit is biggest. Not where excitement is highest. Where friction is lowest. This is counterintuitive to retail thinking. Retail looks for payoff. Professionals look for efficiency. Efficiency compounds. Payoff decays. Markets with structural disadvantages do not announce themselves. They look like opportunity until you zoom out. They reward participation early. They punish consistency later. That is the trap. Early wins anchor belief. Later losses feel personal. But they are not personal. They are structural. This reframing is uncomfortable. It removes the illusion of control. But it also removes unnecessary self-blame. Some losses were never lessons. They were tolls. Soros internalized this before most people were willing to admit it. He did not diversify across everything. He concentrated where structure favored reflexivity, and he walked away from markets where reflexivity worked against him. That walking away is what most traders cannot do, because leaving a market feels like admitting defeat. In reality, it's acknowledging geometry. You cannot outthink geometry. You can only choose where to stand. The next sections will break down 5 specific market categories that professionals do not rotate out of. They remove them entirely. Not because they are weak, because they are honest. And honesty is the rarest edge in financial markets. The first category professionals quietly abandon is the one most retail traders treat as a proving ground. Highly leveraged short-term derivatives. Not all derivatives, not all leverage, a very specific subset. Instruments where time decay works against you every single day, regardless of direction. At first, they feel efficient, small capital, large exposure, fast feedback. But fast feedback is not the same as useful feedback. In these markets, being right too early is indistinguishable from being wrong. The structure does not care about your thesis. It cares about the clock. Professionals notice something subtle here. Even when analysis improves, outcomes remain unstable. Win rates fluctuate wildly. Drawdowns appear suddenly. This is not emotional instability. It is structural instability. When an instrument requires both directional accuracy and timing precision just to survive, edge becomes fragile. Fragile edges break under normal variance. Retail traders respond by trading more. Professionals respond by exiting permanently, because a market that taxes patience is incompatible with long-term capital growth. The second category is more controversial: thinly traded assets with narrative-driven liquidity. These markets look alive, they move fast, they respond to news. But liquidity is not depth, it is permission. In narrative-driven markets, liquidity exists only while the story holds attention. When attention shifts, spreads widen, execution degrades, risk becomes nonlinear. Professionals track this differently than retail. Retail asks, is there volume today? Professionals ask, who must buy after me? If that answer depends on sentiment rather than obligation, the market is unstable. Unstable markets do not fail loudly, they fail quietly. One day fills slip, another day exits take longer. Then volatility spikes when participation vanishes. At that point, skill becomes irrelevant. This is why experienced traders stop touching markets where exit liquidity is optional rather than structural. Optional liquidity is not liquidity, it is a courtesy. Courtesies are withdrawn without notice. The third category professionals exclude feels respectable, even conservative: over-optimized consensus trades. These are trades where everyone knows the logic, everyone agrees on the framework, and everyone is positioned before you arrive. They look safe, they feel rational, but safety priced in is not safety, it is compression. In these markets, upside disappears first, downside remains intact. Professionals notice something unsettling here. Their best analysis produces average returns. Their worst timing produces full losses. That asymmetry is not accidental. Consensus trades punish precision. They reward early access. If you are not early by structure, you are late by default. Retail traders mistake confirmation for validation. Professionals recognize it as crowding. Crowding does not explode often. It suffocates slowly. Months of small gains, one sudden unwind. The risk was always there. It was just hidden by agreement. Once a professional experiences this cycle enough times, they stop engaging. Not because the logic is wrong, because the payoff is already gone. The fourth category is where ego quietly dies. Markets where your counterparty is structurally better informed. This is not about insiders, it is about informational asymmetry embedded into the market itself. Some markets are built around participants who see flow before you, who hedge dynamically while you react statically, who internalize risk while you externalize it. In these environments, even correct trades feel uncomfortable. You sense resistance, slippage appears at key moments. Professionals trust that feeling, not intuition, pattern recognition. If your best trades require fighting invisible forces, you are not trading price, you are trading infrastructure. Infrastructure always wins. Retail traders respond by refining indicators. Professionals respond by asking why the friction exists. When friction consistently appears against you, it is not random. Markets are designed ecosystems. They reward some behaviors and tax others. Professionals stop participating where they are the taxed class. This is not pessimism, it is realism. The fifth category is the hardest to accept: markets that reward constant engagement. These markets keep you active, they provide frequent signals, they generate endless feedback. They also drain focus. Eventually, professionals notice something unsettling. Their most active periods correlate with stagnation, not growth. Activity creates the illusion of progress, but progress in markets is uneven by nature. If a market requires daily decisions to maintain relevance, it competes with your ability to think clearly. Clear thinking requires space. Space requires inactivity. Markets that punish inactivity punish wisdom. Retail traders fear missing out. Professionals fear being occupied. Occupation is expensive. It fractures attention. It increases emotional exposure. It blurs signal discrimination. Over time, these markets erode the trader more than the account. This is why professionals build watch lists, not universes, why they wait more than they act, and why they permanently exit environments that demand constant presence. Now comes the uncomfortable realization. None of these markets are inherently bad. They're just incompatible with long-term asymmetric growth for most participants. Soros did not avoid them because he lacked skill. He avoided them because skill had diminishing returns there. That distinction matters. Skill compounds only where structure allows it. This is the core insight most people miss. Your results are bounded less by intelligence and more by environment selection. Environment selection happens before strategy, before psychology, before discipline. It is a filter, not a technique. Once professionals internalize this, their behavior changes quietly. They trade less, they wait longer, they say no more often, and their equity curves smooth out not because volatility disappears, but because friction does. Friction is the silent killer. Every unnecessary trade introduces friction. Every structurally hostile market amplifies it. Removing entire categories removes friction at scale. This is not about avoiding risk. It is about choosing where risk is paid. Paid risk is acceptable. Unpaid risk is not. In the final section, the focus shifts from avoidance to application. How professionals build exclusion frameworks, how they decide what never returns, and how restraint becomes a repeatable edge.
Avoidance only works if it is systematic. Otherwise, it becomes fear disguised as discipline. Professionals do not exclude markets emotionally. They exclude them structurally. This distinction is everything. The first step is not asking what you like trading. It is asking where your edge survives friction. Edge that disappears after costs, delays, and execution is not edge. It is optimism. Professionals review their history differently than retail traders. Retail looks for mistakes. Professionals look for patterns of exhaustion. Which markets required constant monitoring? Which instruments demanded emotional regulation disproportionate to return? Which categories consumed attention without improving long-term trajectory? Those are candidates for permanent exclusion. Not because they caused losses, but because they demanded effort without proportional payoff. This is uncomfortable because it reframes effort as a liability. Effort feels virtuous. Markets do not reward virtue. They reward alignment. The second step is defining exclusion rules that are not performance-based. This is critical. If exclusion depends on recent outcomes, it becomes cyclical, in and out, hope and regret. Professionals base exclusions on mechanics, not results. Time decay, liquidity dependence, information asymmetry, crowding sensitivity, engagement intensity. If a market scores poorly on multiple dimensions, it does not matter if it sometimes works. It is removed permanently. This permanence creates psychological relief most people underestimate. When a market is truly off the table, it stops generating temptation. You no longer track it. You no longer second guess. Mental bandwidth returns. That bandwidth does not automatically create profits, but it creates clarity. Clarity precedes good decisions. The third step is accepting boredom as a feature, not a flaw. Once exclusions are in place, the universe shrinks dramatically. Fewer instruments, fewer signals, more waiting. This is where most traders relapse. They mistake boredom for stagnation. Professionals understand something subtle. Boredom means noise has been removed. Noise removal does not feel productive in the short term. It feels empty. But emptiness is where pattern recognition deepens. When you are not constantly reacting, you start seeing structure again, not setups, context. Context is what separates random wins from durable ones. The fourth step is measuring progress differently. After exclusions, trade count drops dramatically. Activity metrics collapse. If success is still defined by frequency, confidence erodes. Professionals shift metrics quietly. They track drawdown depth instead of win rate. They track recovery speed instead of profit spikes. They track decision regret instead of missed opportunities. These metrics improve long before P&L does. That is how you know the framework is working. The fifth step is resisting re-entry. Markets you exclude will eventually perform well without you. This is guaranteed. You will see screenshots. You will hear stories. You will feel the pull. This is the final test. Professionals remind themselves why exclusions exist, not because the market never works, but because it does not work consistently for them. Consistency is personal. What compounds for one participant erodes another. Soros understood this deeply. He did not universalize his approach, he personalized it. His genius was not prediction, it was selective participation. He treated markets like environments, not opportunities. Some environments nourish growth, others consume it. Once you see markets this way, behavior changes naturally. You stop chasing completeness. You stop trying to trade everything well. You accept that saying no is a form of strategy. This acceptance brings a quiet confidence, not the confidence of certainty, the confidence of alignment. Alignment between skill, temperament, and structure. That alignment is rare. It cannot be forced. It must be protected. Permanent avoidance is one of the few tools that protects it. This is why professionals sound repetitive when they speak privately. They are not searching anymore. They are maintaining. Maintenance is invisible from the outside. It looks like inactivity. It looks like missed moves. Inside, it feels like stability. Stability does not generate stories. It generates longevity. Longevity is the real edge. Most traders burn out not because they are wrong, but because they are everywhere. Everywhere drains energy. Energy loss precedes capital loss. By excluding entire categories, professionals conserve both. This is not about fear. It is about respect. Respect for limits. Respect for structure. Respect for time. Time is the only resource that doesn't replenish. Money can be rebuilt. Reputation can recover. Time only moves one way. Markets that waste time are more expensive than markets that lose money. This is the final reframing. Permanent avoidance is not retreat. It is prioritization. It is choosing where your effort has meaning. Once that choice is made, trading becomes quieter, not easier, clearer. And clarity over enough cycles becomes its own form of edge.